Hey, here we are. How are you all? Very good? Fantastic? You know, I watched the last, this is lecture 222, is that right? I watched the previous lecture on chapter 17. I gave you a lot of information in a short amount of time, did I not? Okay, so I apologize for that. There's really no good stopping point anywhere in there, and I needed to get all that information in. For you folks at home, you have the advantage of, if you ever need to just take a break and you know, go and have a glass of wine or something, just push pause, okay? Because I know I threw a lot of information at you, okay? So, and I was doing it pretty rapidly, okay? Like I said, on this chapter, on chapter 17, financial statement analysis, it's an extremely important subject, and I wish I could do more than just introduce it. But we have a finite amount of time, and I have a set amount of material that I have to get through in accounting too, and we can't spend much more time on it. And it's a little bit that way with the cash flow statement too, even though it may seem like we spent a lot of time there. But you address both of those subjects in managerial accounting. If you take managerial accounting, and if you're getting an accounting degree and maybe even a business degree, you'll have to do that. How many people have to take managerial accounting? Raise your hands. Okay, more than half of you. So, so again, I acknowledge that this is simply an introduction to financial statement analysis. Okay, let's go ahead and go through the homework. All right, I will try to stop and take a few deep breaths this lecture so it's not as frantic as the last one. Okay? All right. Let's take a look at the first few were, I think, fairly easy, right? The first one we did was Quick Study 17.4. Is that right? Quick Study 17.4. Okay. Compute the annual dollar changes and percent changes for each of the following accounts. Okay? Well, we can do that. The dollar change is really easy, right? You just subtract, right? And then the percent change, you just take the dollar change divided by the base period amount. Okay? Is that what y'all got? Okay. Now, this last one, you cannot, let me see here, $88,000 change. Why is that not calculable?
So 100 should be 100%, and the 88,000 should be negative.
Oh, okay. There you go. All right. I was looking at my years reversed. Okay. So that is not calculable, right? Is that correct? Okay. All right. Any questions on that? Any questions on that? Okay.
Yeah, how is that not calculable?
Well, the reason it's not calculable is this is the base year, right? Mm-hmm. This is the next year. So the dollar change is what?
100%.
Negative 88,000.
Negative 88,000.
Negative 88,000. So negative 88,000 divided by 88,000, I guess that's negative 100%, right?
Yeah.
Okay. So I guess you really could do it. The way I read that to begin with, and I wonder if they almost made a mistake, is I know you can never divide by 0, right? Is that correct?
That is very correct.
So if this would have been 0 and this would have been 88,000, to me that should have been the true not calculable. Do you agree? Mm-hmm. Okay. So, but I think we know. We good? Mm-hmm. Okay. You can never divide by 0. But I think technically maybe this should have been a negative 100%. Okay. But you're not going to have a whole lot of situations where it goes from 88,000 to 0 anyway. Okay. And it's not, you have to take that measurement with a grain of salt. But I don't want to spend a whole lot of time on that. But does that make sense? Mm-hmm. Okay. All right.
If we have a test question like that,
I'm not going to try to trick you or anything.
okay.
So, but you should be able to figure out the percent changes or whatever. So, I don't ever try to trick you, do I? No?
You're the first teacher.
Okay, thank you. All right, let's go through the exercises. All right, exercise 17-3. Okay, let's go ahead and take a look at exercise 17-3, which is right here, okay? Compute trend percents for the following accounts using 2011 as the base year. Round the percents to whole numbers. State whether the situation as revealed by the trend appears to be favorable or unfavorable for each account. Okay, well, let's go ahead and do that. Okay, so we have our raw data here, right? What we're going to do here is divide each number on each line by the 2011 amount. Okay, this is the base year, right? And I always like to draw an arrow from 2011, 12, 13, because time is moving this way, right? And I do that because sometimes other places will list it the other way, won't it? And so I just like to clarify, okay? So you're going to take each number in each line divided by the base year amount of that, okay? So take a look at this data. We can see that sales is increasing. We can see that cost of goods sold is predictably increasing, as well as accounts receivable predictably increasing, correct? Once we divide those amounts, we get this data right here, okay? These are obviously 100% because something divided by itself is 100%, 156%, 159%, and so on. Okay, so check your numbers there for a second. I'll give you a minute before I talk. Okay. All right, any questions on that? Let's talk about the interpretation of it, but did you get those numbers?
No, I got.
Yeah, I just did.
I did the other way. I did the way we did in the very first problem. So I got like 89%. I didn't do like the 100. So I was 100% off on all of them. But I had that I had like the 89. But I just
Where'd you have 89?
I took the So what I did is I took.
2015.
So what I did was I took like 150 or like 234, 50,
Yeah.
560 divided. I mean minus 150 to like the
So
change.
what you said here is like, well, let's just do this one. You had 56% here. Okay, you had 56% right there. Well, they're both pretty much saying the same thing. What they're saying is the 2012 amount is 156% of the 2011 amount. Okay, and if you want to figure that up, you could just take like 1.56 times that base period amount, and that would equal that amount there. Okay, but so you got 56, 68, 81, and 89.
I did it on all of them too.
That's all right. I mean, there are different ways of doing this. There really are different ways of doing this, okay? So I think you're going to be able to reach the same conclusions that we're going to discuss here by the way you did it. And that is this. Let's take a look. Sales is increasing. Clearly sales is increasing, right? Now, that's good that sales are increasing. We don't know off the bat though if that's a completely favorable thing, because what if our competitors are increasing at a much greater rate? You see what I'm saying? So you can't just say increase, that's good. Well, if our competitors' rate of growth is a lot more than ours, then I'm glad we had a rate of growth, that we grew, but we're lagging behind our competitors. So you have to compare it with something else, okay? Now, the other alarming thing here, well, we don't know if that's alarming or not. We don't know the competitor's rate of growth. But something that is alarming is that our cost of goods sold is increasing at a greater rate than our sales. Would you agree? Mm-hmm. Cost of goods sold is increasing at a greater rate than our sales. So I can tell you what is happening here is that our gross profit, which is sales minus cost of goods sold, or gross margin, same thing. We definitely have gross margin erosion here, don't we? Okay? our costs are increasing and we are either not passing them on to the customer or we're not able to, okay? The other thing is our receivables are building up at a quicker rate, okay? Our receivables are building up at a quicker rate. Why is that happening? I don't know. Maybe our sales are increasing because we're taking on customers that have less credit worthiness, and that might be a good thing. But we need to know, why are our receivables building up quicker than our sales? Okay. So I want you to see, though, that those conclusions really can't be reached if you're just looking at this, especially that one, because that's the wrong one. It can't be reached if you're looking at, where did it go? This one. The raw data. Okay? If you're just looking at this raw data, you can't really see that gross margin erosion is occurring. Is that correct? Okay? Make sense? All right. So this is all a means of transforming data into a method that can be better understandable, and thus you can make better decisions on it. Okay? Cool? Okay, questions on that? All right, let's go to the next one. Exercise 17.5, is that correct? Okay. Exercise 17.5 is right here, okay? Express the following comparative income statements in common size percents and assess whether or not this company's situation has improved in the most recent year. Round the percents to 1 decimal, okay? All right. Let me say one thing real quick, too. Come off the Elmo for a second. How many of you regularly use Microsoft Excel? Anybody? Okay. There's like 2 hands out of 13, okay? So that's not even 20%. I give this speech in my managerial accounting class, but do you ever see somebody who still handwrites term papers instead of using like a word processing? Nobody does that anymore, right? Okay. Well, that's because it's extremely inefficient and crazy to write out a term paper. We used to do it back in the olden days, okay? But when I see people, and I did a homework check today, when I see people doing their homework of this nature and doing it with a calculator and a pencil, I feel the same way as you would if you saw somebody writing out a 12-page term paper. Microsoft Excel is the software you need to know if you're getting a business degree. I mean, this is all so much easier if you use Microsoft Excel, okay? Now, if you take managerial accounting from me, I actually am going to teach you Microsoft Excel the first week of class, and I'm going to make you use it the whole semester. And at the end of the semester, you will thank me, because everything will be easier. Is it easier to write out is it easier to type a term paper than write it out? Yes. Is it easier to use Excel? I bet whatever time you spent doing your homework, you could have cut it in half if you would have had a working knowledge of Microsoft Excel. So that's my advertisement for Bill Gates and Microsoft Excel, okay? Learn how to use it. It's a powerful program, okay? All right, let's take a look at this, though. Okay, they want us to do vertical analysis, and they want us to divide. What we're going to do is, let me zoom in here a little bit. We're going to divide each one of these amounts by the sales number to figure out what percentage of sales it is. Is that correct? Okay. So once we do that, here is what we get. Zoom out a little bit. Time is going this way. Take a look at your numbers before I start yakking. See if you calculated them right. Okay. Anybody get this? Got this, Creighton? Okay. Did you do it different?
I just did. I didn't even do that at all.
Okay.
I just did the exact thing we've been doing. I did like the change
Okay.
between the two.
That's all right. I don't mind when you make mistakes on your homework. I always say a mistake you make on your homework is one that you would have made on a quiz or test and you just got it out of the way. Okay? All right. Now, okay, any question on how we got any of these numbers? Okay. What is the thing that just stands out like a sore thumb here?
That the percentage of their net income was significantly lower than in 2013 than it was in 2012.
This is significantly lower than that. That is major net income erosion as a percentage of sales.
Gross profit.
And it mainly stems from right here, doesn't it? Okay? Our gross profit margin, or gross margin percentage, went from 53.5 to 24.3. That is more than half. I mean, it's less than half of what it was, right? Okay. Now, is that a problem? Is that a concern?
Yeah.
Yes, it is a concern. Now, this also, well, hold off. That is obviously a concern that you need to look into, right? What is happening here? What is happening here? This will kill your company quickly. Now, the only thing I don't like about the way that I see accounting textbooks teach this information is this. You don't usually see that drastic of a change in a sample of data of 2. Does that make sense? In real life, what you see is you see gross margin. If it's getting worse, it's doing this, okay? Okay? It's doing this. I think we talked about that last time, didn't we? Okay? They only give you 2 data points, so they're doing this. Well, that's fine, but that's not real life, okay? Okay? You ever watch the show The Biggest Loser? You ever watch that show where people weigh themselves and then they try to lose weight? Okay? And I have a son who likes that show. And they'll weigh somebody and they'll weigh 500 pounds. And my son says, how does somebody get to weigh 500 pounds? And I said, just 1 pound at a time, right? You don't see changes as drastic as this in real life. That person's weight slowly went up. They weren't 190 one day and 500 the next, right? What I wish they would do in these problems is not concentrate so much on you calculating things, but just give you the data that's calculated and work on analyzing it. Does that make sense? But you really need 10 years. I would have liked to have 10 years or have quarterly data for the last 5 or 6 years. And we could have really analyzed those trends because that's closer to what real life is. So they're making it extreme. But I want you to recognize that in real life, that's probably not going to be the case. Cool? All right? And I also want you to recognize that if you are writing this out using a calculator and a pencil, doing monthly data for the last 4 years would be extremely time-consuming. But if you use Microsoft Excel, boom, it could be very easy, and that's what we do with our clients, and it's not that hard. But boy, you can spot some great trends, some excellent trends doing this stuff. Okay? All right. Let's take a look at the next ones are 17, 7, 8, 9, 10, and 11. Is that correct? Yeah. Okay. So what they do here is, let's take a look. They give us this balance sheet. Okay? They give us this balance sheet. Simon's year-end balance sheet follows. The first thing they want us to do is express the balance sheet in common size percents. Round amounts to the nearest 0.1%. That's the first thing they want us to do. So let's do that. Okay? All right. Let's take a look at the answers. Once again, go ahead and check your numbers before I start yakking. Okay, we're dividing every one of those numbers by total assets, right? Okay. Did you get this one, Jeremiah?
I didn't start this one.
You didn't do this one? Okay.
So On the last one, you did it by sales. On this one, you did it by total assets.
Yes. When we
Or-
do common size, good point. When we do common size financial statements with an income statement, we're dividing every item by sales. On a common size balance sheet, we're dividing everything by total assets. Okay? Which would be the same thing as total liabilities plus equity, right? Okay? So this is the numbers that we get. Okay. We're moving from this way to this way, right? What do we see here? What sort of observations do we see? Anybody want to throw one out there?
Accounts receivables going up as well as our inventory.
Accounts receivable, okay, has increased as a percentage of our assets, right? Okay? So this could, we want to look into this. Is there some risk of uncollection here? I don't know. Why is this increasing? Now, this is a lot like when you go to the doctor and you do a medical test, okay? The medical tests might tell you where the problem is and if there is a problem, but then the doctor has to go in and do more analysis on whatever area it is, right? And that's how this is. We need to go figure out why are receivables increasing? Why are receivables increasing as a percent? I don't know. All we know right now is that they're a larger percentage of total assets. Okay? We also know that cash is a smaller percentage of total assets. Now, that may not be a negative thing. Maybe we're putting those things into productive plants and equipment or whatever. Okay? Or plant equipment is going down as a percentage of assets as well. But we need to look into why these are changing, right? Okay? Inventory is a higher percentage of total assets, isn't it? It's getting larger each time as well. And payables is a larger percentage. Is that correct? I'm starting to not feel real good about this Simon Company. Now, I don't know yet, but when I see receivables, inventory, and accounts payable increasing as a percentage of total sales, I'm getting a little nervous. We're going to do some more analysis, though, on this company that will help us. Okay? All right. Any questions?
Does liabilities and equity always equal the assets as far as the totals?
Yes. I mean, if you go back to the original data, your balance sheet has to balance, right?
Right.
So whatever your total assets is has to be the same number as liabilities plus equity.
Okay, I get it. Thanks.
Okay? If their balance sheet doesn't balance, then you got real big problems. Okay? Good question. Okay, let's go to the next one. The next question, 17.8, says they want us to refer to that balance sheet and analyze its year-end short-term liquidity position at the end of each year by computing the current ratio and the acid test ratio. You with me? So, let's go ahead and do that. All right. Take a look at the computations to see if you got them right. I always like to draw arrows whichever way we're moving.
Do I say 2-1?
Say what?
All your ratios say 2-1.
Oh, they say 2-1. Well, if you say something is 1.88, that's the same thing as 1.88 over 1, or sometimes it's stated as 188.88 to 1. I don't usually use that terminology. I usually just put these numbers right here. Okay? So, good point. Okay? All right. As far as these ratios, what do these ratios measure? They both measure the same thing.
Your ability to pay debt.
Ability to pay debt in the short term. Okay? Current ratio is current assets divided by current liabilities. The acid test ratio realizes and recognizes that not all current assets are equal, so they only count in the numerator certain items, quick assets, which are cash, short-term investments, and receivables. Okay? Okay, are things getting better or are things getting worse in regards to these two ratios?
Worse.
They are definitely getting worse. Once again, the trend is pretty extravagant here, okay, because they wanted to show it, okay? The trend is pretty obvious, okay? It's usually not that obvious in real life, okay? So, I would be curious to see what the industry ratios are, okay? Let me ask you this. Let's come off there for a second. A current ratio. All things being equal, do we want a current ratio to be high or low?
High.
High. Can a current ratio or an acid test ratio, can that ever be too high? Can it ever be too high?
What do you mean they're not utilizing their cash?
Yes, the answer is, as Henry is addressing here, the answer is yes. A current ratio could be too high, okay? I mean, think about it. If, let's say a company was getting behind their competitors because they weren't putting money into new plants and equipment. They weren't putting cash into research and development. They weren't working on more efficient processes. They were just hoarding their cash. Would that make sense? Okay? Does that make sense? You're saying, okay, that's great that we have a lot of cash, but we're getting behind because we're not putting that cash to use in developing a new product or developing a more efficient process. Okay? Think about it on a personal level. Let's say every now and then you'll hear of somebody dying and they lived in an old, beat-up house and their health was horrible, but they had tons of cash. You ever hear about that? Somebody, and they're usually like really elderly. Well, is that a healthy situation? Well, they had a lot of cash. Can you have too much cash? Yeah, you should have used some cash to take care of yourself, to keep up the house that you live in, right? You see what I'm saying? Here's what it kind of reminds me of. Has anybody here, did anybody here ever take like a weightlifting class? Or anybody ever done that? Okay, I took a weightlifting class, believe it or not. I took a weightlifting class when I was a senior year. Well, we had these guys in our weightlifting class that we would laugh at kind of behind their backs. Because here's the only exercises they did were this. They did the bench press, they did curls, and they did triceps. That was it. Did you ever know guys like that? And they would stand in front of the mirror, and meanwhile, they had little chicken legs, like Daffy Duck. Did you ever know guys like this? And you're like, hey, buddy, I know the mirror only goes from here up. You look ridiculous. How about working a little bit less on the bench press and working on your legs? Because you want to be an overall healthy, muscular person, right? Did any of you guys lift with people like this? Okay. Okay. So it's a little bit like the current ratio. That's great your current ratio is healthy if it is. But it's one measurement, right? Okay, so the current ratio can be too high if the rest of the company is suffering, right? Your biceps can be too big, okay?
Just thinking, if your current ratio is really high, but you have like no debt, and that's why it's high. Like, doesn't matter how much cash you have, it's going to be super high because you have no debt. Wouldn't that be a case in which it'd be okay to have a high?
Yes, but here's what I would need to know. What he's asking is, well, what if? Because you're acknowledging you don't want to be hoarding a lot of cash if you have a lot of debt, maybe at a high interest rate. But what if you have no debt? I still would say this. How is our property, plant, and equipment looking?
Well, what if like a total percentage of your assets that's really high and you only have like maybe 5% of its cash, but you have even less debt than that, and so it inflates your current ratio to be super high.
Because your current liabilities are low?
Because your current liabilities are
Yeah,
non-existent.
you're right there. Yeah, I see what you're saying. What if you're saying it's not so much of a result of the numerator being high, it's the denominator being low? It could be. And again, it's just something that you have to analyze.
Have you ever been to like a company where you've had to like say your current ratio is too high? Like,
I've been consulted with companies that I said, you need to not just be focused on, you need to be developing new products. You're getting behind the competitors. They're developing new products, and you need to be making sure that you have a plan to invest some of your cash into research and development or into new fixed assets that are more efficient. Yeah. Okay. So I think you get the general gist of what I'm saying, right? But this company, going back to it, it's getting worse, isn't it? Getting worse. Now, the one thing that I would like to do here that I can't do is I would like to compare it to competitors or to the industry averages, okay? Because there are some industries that typically have higher certain ratios or lower certain ratios because of the nature of what they do, okay? We don't really know. All right? Any other comments or questions on exercise 17.8? Okay, no? Okay, well then let's take a look at, it's kind of a continuation of this, isn't it? All right, let's take a look at exercise 17.9, is that right? Okay. All right, they give us some more information. You can actually just see all the data for 17, 9, 10, and 11. But they give us an income statement, 2 of them, right? Okay, they give us an income statement, and they ask us, they say, refer to the information from the previous exercises. The income statements are below. They want us to compute days sales uncollected, accounts receivable turnover, inventory turnover, and days sales in inventory. Okay? These are really important ratios. Okay? Let's go ahead and compute those. Once again, I'll let you look at your computations. And then we will comment on them. Okay? Anybody get those? Yeah? Okay. These aren't real hard to calculate, are they? Okay? Not real hard to do. Okay. You can see the direction of time. We're going from 13 to 14, 13 to 14, and so on. We only have 2 data points, but let's take a look at our receivables. Is this situation getting better or worse? It's getting worse. Our receivables used to, in 13, turned over 9.5 times almost a year. Now they're turning over slower, 8.9 times, correct? All right. Days sales uncollected. Well, 42.9 was the days sales uncollected last year. Now the receivables are getting older, right? Okay. Now, we want our receivables to turn over, okay? Did I use the restaurant analogy last time? You want the table to turn over, right? You want it to turn over. You want your receivables to turn over. What are some reasons that accounts receivable could be slowing down? They're not getting collected as much.
People not paying.
Well, people aren't paying. That's definitely what's happening. But why might that be happening, that they're not paying?
Your billing could be slowing down.
Your billing could be slowing down. It could be a process situation. Maybe you have a new billing department and they're quite frankly behind, or they're not as efficient as the people you used to have. Maybe you used to have a person who was really good about calling the people and saying, hey, your bill is 25 days old. Is there a problem? You need to get that paid. And then the new person, he doesn't do that. Okay? What are some other reasons that receivables could be slowing down?
You're taking on customers with less credit and they aren't able to pay.
Taking on customers that don't have as good credit, right? Okay? The credit worthiness is not as good. Okay, what are some other reasons?
State of the economy.
Yeah, the economy, the state of the economy could be worsening. Okay? So, a lot of times what you'll see, well, I'll wait to give that interpretation until we go through the next ones. But there's a lot of reasons, and this would tell us that we need to go investigate why are receivables slowing down. Now, take a look at the inventory turnover. Inventory is slowing down too, right? Inventory is slowing down. Is that a good thing? No. No. Why might inventory be slowing down? What does that mean?
Less customers. People aren't buying your stuff.
People aren't buying it as quickly. We want to buy inventory, we sell it, we get the cash, we buy more inventory, we sell it, just like that table that you work at the restaurant, right? Inventory slowing down. What's the reasons that that could be occurring?
Prices could be going up.
Maybe prices are going up.
You're just stocking way more inventory than you need.
You could be stocking more inventory than you need, okay? There's risks of stocking too much inventory. There's risks of stocking too little inventory, right? One of the main things that we do when I go in and consult is I look at the quality of their inventory. A lot of times when you have inventory that's slowing down, it's because they have what we call dead inventory, right? What are some examples of inventory that maybe was once very popular for customers to purchase and now is a lot less popular for customers to purchase?
Holiday ornaments.
Well, holiday ornaments, but the only good thing about holiday ornaments is it happens every year, right? Let me give you some extreme examples. What if you had a bunch of VHS tapes that you were trying to sell? How are those selling these days? Are they selling as quickly as they did 10 years ago?
No.
Okay. How about Tim Tebow and Adrian Peterson jerseys? How are those selling right now? Huh?
They're not.
They're not selling. What about a bunch of iPhone 3s? Do you see what I'm saying? What if you really stocked up on all those items thinking because they were selling so quickly and now the inventory's slow? After a while, you have to look at the quality of your inventory. And sometimes you even have to say, this inventory is not worth anything anymore. And then you write it off the books, which hurts their P&L, their profit and loss, because you write it off, you expense it, and they hate that. Hurts their assets, hurts their bottom line. Okay? But a lot of times they'll hold on to that inventory. No, this is still good. This is still good. People still want Tim Tebow Denver Bronco football jerseys, even though he doesn't play there anymore and he's not even in the NFL, right? People still want 2012 calendars. No, they don't. It's not worth anything. It's dead inventory. You with me? Okay? So, do you think these sort of ratios and analysis over time would be useful to a manager or an owner of a business?
Yes.
Yes, it would be. And yet, do you know how little business managers do this? Did I tell you about my buddy who plays fantasy football? He spends more time analyzing his fantasy football team than he does these ratios for his business. Doesn't make any sense, does it? Okay? All right. Good stuff. This is such good stuff. Such good stuff. If you can learn and be able to analyze financial statements and see trends and see things that maybe other people can't see because they don't know how to use those tools or they don't have the experience, that is an unbelievably beneficial trait. You can make money off of that, okay? It's a wonderful skill to have, okay? I work with somebody who is very good at financial statement analysis. He can just look at things and see what's going on, okay? It's like it's like Da Vinci Code. He can spot what's going in there. The other thing that sometimes you can find is fraud. He said, there's something happening that's not quite right here. Something's happening, and he can tell it just because of the trends and the way things are moving. He's very good at it. He's taught me a lot. Matter of fact, he's taught me more about it than anything I ever learned in my accounting degrees because they didn't teach financial statement analysis very well back in the old days. Okay?
Are we going to look at some actual financial statements later
Are we
on?
what?
Are we going to look at like some actual financial statements later on?
No.
No.
And the reason is that would be he's asking like if we would take like a real life annual report or something like that. It's a matter of time. I still have 6 chapters I got to get through. You see what I'm saying?
Yeah.
If you take managerial accounting, it's a very common business project to do what you're saying. I'm introducing you to this subject. And but you might, if you get an accounting degree, you'll probably spend a whole semester doing this. But it takes a while to do. Okay? Great question. All right. Let's go through 1710. All right. What does 1710 ask us? Refer to that information. Compute the long-term risk and capital structure positions at the end of 14 and 13 by computing the debt and equity ratios, the debt to equity ratio, the TIE ratio. These are all ratios that have to do with solvency. Is that correct? And the ability to pay your debt in the long term. Is that correct? Okay. Let's look at our debt and equity ratios. Okay, our debt used to be 39.7% of total assets. Now it's 43.7. That indicates, and that as well as a declining equity ratio, because obviously these have to add up to 100%. What this is telling me is that our financing is more with external finance, not with owner financing, but with banks, credit unions, those sort of things, right? We're taking on more debt, correct? Taking on more debt, it's becoming a higher percentage, okay? Think of all the Johnson County families out there. They gradually get more debt, but that debt has to be repaid, doesn't it? Okay, that can cause problems, all right? The debt to equity ratio is also growing. That's really just another way of measuring these up here, is you take total debt divided by total equity. And then there is the TIE ratio, okay? Now, the TIE ratio is the times interest earned ratio. And it is calculated by taking EBIT, which stands for earnings before interest and taxes have been subtracted, divided by interest expense. Now, do you want, all things being equal, do you want this ratio to be high or low?
High.
High. And I always ask myself, well, okay, what would give me a high TIE ratio? A high numerator. Wouldn't you rather your earnings be really high and your interest expense low? Mm-hmm. So you'd rather, you certainly don't want low earnings and high interest expense, which would give you a low TIE ratio, right? So all things being equal, you want this to be high, and it is actually growing a little bit, right? It did improve, okay? Why is that? Why could this say our debt is growing, and this is, which seems to say more debt, but our EBIT ratio seems to be improving?
Maybe interest rates are dropping.
It could be interest rates dropping, but it could also be that this is mainly occurring because of short-term debt that doesn't even have interest, like accounts payable. You see what I'm saying? You see how your total debt could be increasing, but if it's accounts payable that's increasing, it won't have interest expense, so this ratio could maybe show improvement. Make sense? Okay? I know this is the first time you go through this stuff, it's kind of difficult. But the more you analyze these things, the better you get at it. Okay? All right. Any other questions on the debt and equity?
How do you get EBIT? Like, I couldn't figure that part out.
Earnings. How do you get EBIT? Earnings before interest and taxes. That's a good question. Okay? Well, what we do here is, let me find the right page. Okay? Let me zoom in. Well, you can't just take this net income number. Now, they don't have a subtotal for EBIT. So what does EBIT stand for? Earnings before interest and taxes have been subtracted. So EBIT would equal 31,100 plus interest expense plus income taxes. Is that right? Somebody who got it? Creighton? Yeah. So you have to add those back. In a way, you're making a subtotal before these two items are subtracted. It's a great question, Daniel. Does that make sense, folks? Very good. Okay. Let's do the last one, which is 1711. And they're asking us about this data. Evaluate the efficiency and profitability by computing the following for 14 and 13. The profit margin ratio, the total asset turnover, return on assets, Okay, let's do that. Okay. Let's do that. Well, I think we've already noted before that our profit margin is declining. Didn't we note that in a previous exercise? Okay. All right. Our profit margin is declining from 5.5 to 4.6. Okay. Here, let me take a look at something real quick. So profit margin is getting worse. Now our asset turnover, what is asset turnover? That's how efficiently we are generating sales from our assets. Okay? That's actually improved. Okay? Now, if you recall, and I know I had to hurry through this quickly last time, but one way we can figure out ROA, also the same thing as ROI, is by taking a profit margin times our asset turnover. Okay? Profit margin times our asset turnover. Okay? And the results of that will be a return on assets. This situation, the return on assets actually, I'm sorry, here we're up here. The asset turnover actually improved, didn't it? From 1.3 to 1.4. But it certainly wasn't enough to offset this deterioration of profit margin. So the result was that ROA actually worsened. Does that make sense? You with me? Okay. All right. That was it for homework, wasn't it? Here's what I'm going to do, okay, as we close out. There's no pencil and paper homework next time for the next lecture. We are going to start chapter 18 next time. But here's what I'm doing in regards to chapter 17. Well, let me back up. Chapter 16, did I tell you about that Connect project, the 15-point? It's not, even though it's on Connect, it's not calculated with your other Connect scores. It's 15 standalone points towards your overall grade, face-to-face and online, for doing that Connect project on the cash flow statement. I'm doing something similar with chapter 17. On Connect, I have a mini project, so to speak, that's worth 25 points towards your overall grade. Once again, the 25 points on that chapter 17 mini project are not part of your overall Connect score. It's totally separate. So if you are one who always forgets to do Connect assignments, you do not want to forget to do this chapter 17 25-point one or the chapter 16 15-point one, because they are worth a lot more than other Connect assignments. They're not included in that computation. You guys following me? So go look at the due dates on that. Go do those. You have the knowledge that you need. Consider both of those things kind of open book, take home little projects. Okay? And then next time we will start chapter 18. All right? See you guys later. Have a good one. Bye-bye.